I want to start off today's video with the most common thing I hear when I tell someone that I work with whole life insurance. They say, "Isn't whole life insurance a terrible investment?" My answer is yes, sometimes, depending how it's designed, who sold it, what it's being used for. That it's like asking, "Isn't a hammer a terrible surgical tool?" The answer is yes, if you're trying to perform surgery, but it may be a great hammer. Today we're going to talk about what whole life insurance actually is, what it isn't, and why a properly structured dividend-paying whole life insurance policy is fundamentally different than what most people are picturing when they ask that question. I'm Jared with Green Dot Wealth, and today we're going to talk about some of the objections that show up. I want to be clear about something before we go any further. I welcome this question. I actively want you to ask it, because the people who ask the hard questions are the people who, once they understand the answers, become the most committed to the concepts. Skepticism isn't the enemy of infinite banking. Misinformation is. So let's deal with that information head on. First, let's give the objection its full credit, because it follows a clear chain of events. There's a real story here. Cast your mind back to the late 70s, early 80s. Interest rates in the United States were historically high. The Fed had pushed them above 20% at one point to try to crush inflation. You could walk into a bank and buy a CD earning double digits. Money market accounts were paying high returns that whole life insurance simply couldn't compete with on a raw yield basis. And into that environment stepped consumer advocates, most notably Ralph Nader. Along with a wave of critical journalism that took a direct aim at whole life insurance, the argument was straightforward. Why lock your money into a whole life policy earning modest guaranteed returns when you could buy cheap term insurance and park the difference in a money market account at 12%? It was a legitimate question for that specific moment in time. And the criticism landed hard. Whole life's reputation took a hit that it never fully recovered from, even as interest rates normalized and the calculus changed completely. But here's the part of the story that rarely gets told. The insurance industry's response to that criticism didn't make things better. It made them worse. Rather than educating the public on the proper use of whole life, the industry pivoted. They created new products, universal life and eventually indexed universal life, that looked like whole life on the surface, but were fundamentally different underneath. These products transferred risk back to the policyholder. They tied performance to market indices. They introduced flexibility that sounded appealing, but removed the guarantees that made whole life valuable in the first place. They were, in many ways, the industry saying, "Fine, you want the market upside? Here, but you're taking the downside too." The result is the marketplace full of products with confusing names, complex structures, and the print that most buyers never fully understand. All born from a moment of criticism that was partially valid, but led to solutions that were worse than the original problem. So when someone tells you whole life insurance is a bad deal, they're not entirely wrong about the history. They're just applying a 1983 critique to a 2026 conversation. Those are very different conversations. So let's talk about what properly structured dividend-paying whole life insurance actually looks like, because this is where the explanations fall short, and I want to give you the full picture. As a small disclaimer, remember every single one of these items could be their own specific video. We could spend an entire video on each one of these topics by themselves, but we're just going to do the high overview for today. Let's start with mutual companies versus stock companies. A properly structured policy for infinite banking is written through a mutually owned insurance company, meaning the policyholders are the owners. There are no shareholders demanding quarterly returns. Profits are returned to policyholders as dividends. This matters because the incentive structure for the company is aligned with you, not the stock price. Next up, paid-up additions. This is the engine of the strategy and what most traditionally sold whole life policies either don't include or include minimally. A paid-up addition, or PUA, is additional, fully paid up insurance purchased on top of the base policy. It generates immediate cash value and compounds from day one. When a policy is properly structured, a portion of every premium dollar goes into PUA, which dramatically accelerates the early cash value. Another term used in whole life is MEC. MEC stands for Modified Endowment Contract. The Modified Endowment Contract test is a 7-pay test that looks at how much funds are spent for insurance over the course of a 7-year period, and then analyzes that against how much cash you have placed within the policy. If you exceed that limit or the cost of 7 years of insurance, it is considered to have MEC'd, or you have created a modified endowment contract. Another topic that shows up commonly in whole life insurance, or specifically infinite banking concepts, is a low base, high PUA design. Traditionally sold whole life is usually structured the opposite way: high base premium, low or no PUAs. A policy built for infinite banking flips this ratio intentionally: lower base, high PUAs, which maximizes early cash value, but also builds the system that you can access throughout the lifetime. This design matters. The same product name, whole life insurance, can produce radically different results depending on how it's built. A poorly designed policy deserves the criticism it gets, yet properly structured, dividend-paying whole life insurance is a completely different conversation. And yet, with all this said, it's so important to remember that the whole life insurance, while it's the vehicle, it's the product, it cannot be replaced for the information learned in the process, which is infinite banking concepts. The product itself is useless without understanding what you are doing and what you are building. So here's where I want to push back on the framing of the original question: isn't whole life a terrible investment? Because that question contains a hidden assumption. It assumes that infinite banking is trying to compete with your investment accounts on rate of return. It's not. We talked about this in week 2 of the series. IBC isn't an investment. It's an order of operation, a foundation, a warehouse where your investments sit on top of. So the right comparison isn't whole life versus S&P 500. That's the wrong race. The right comparison is, what is your capital doing between uses? When money's sitting in your savings account needing to be deployed, waiting for the right investment, waiting for an opportunity, waiting for an emergency, what is it earning? What risk is it exposed to? Who controls it? In a savings account, low yield, inflation drag, bank controls it. Yet in a properly structured, dividend-paying whole life insurance policy, you've got guaranteed growth, dividends, tax advantages, and you control it. And it's still accessible the moment you need it. That's the real comparison. And when you frame it that way, the question slips from being, is this a good investment, to, is this a better place for my capital to live while it's waiting to work? For the right person, with the right setup, and the right policy, the answer is almost always yes. In addition, there's something genuinely useful here, because not everyone who sells whole life insurance understands infinite banking. And not everyone who claims to practice it is structuring their policies correctly. Here are 3 questions you should ask anyone before you let them decide a policy for you if your goal is infinite banking. Number 1, are you an authorized IBC practitioner? The Nelson Nash Institute certifies practitioners who have been specifically trained in the infinite banking concepts. That's not the only credential that matters, but it's a meaningful filter. Number 2, how do you structure base premiums versus paid up additions? If they can't answer that clearly, or if the ratio heavily favors the base policy, that's a red flag. A properly structured policy should have a meaningful PUA that accelerates early cash value while building the rest of your policy. Number 3, which companies do you work with, and are they mutually owned? If they're placing policies with stock companies, that's worth understanding. Most IBC practitioners work exclusively with mutual companies. You deserve to work with someone who can answer these 3 questions confidently and transparently. And if you're ever unsure, ask again, ask differently, or find someone else. If this video opened something up for you, if the objection you came in with is starting to look a little different now, here's what I'd encourage you to do. Go pick up the book, Becoming Your Own Banker by R. Nelson Nash. I'll put a link in the description. It's a short book. You could read it in a weekend, and it will give you a full philosophical foundation for everything we've been building in this series. Read it, sit with it, let the concepts settle, and when you're ready to talk about how those concepts can apply to your specific situation, come book an appointment with me. You can do so at green.wealth.com. Book a free 30-minute discovery call. If you want to go even deeper between now and then, there's a blog on the website that covers these concepts in more detail. It's worth bookmarking. Links to the book, the blog, and the booking page are all in the description. Hit subscribe because next week we're closing out the first season of the most transparent video I'll put out. I'm going to tell you exactly what infinite banking can't do. The real limitations, the things that don't get talked about. If that does not sound like a sales pitch, good. It's not supposed to. I'm Jared with Green Dot Wealth, and I'll see you next week.